Welcome to the Von Nelson podcast. Today is the first quarter 2026 Von Nelson Emerging Markets podcast. And with me today is portfolio manager Kevin Ross. Welcome, Kevin.
Thanks so much, Dan. Happy to be back.
All right, Kevin, good seeing you here. Let's start getting into it. But maybe before we just jump into the quarter, why don't you just briefly remind our listeners of the investment philosophy, specifically around the capital allocation framework, how that shapes the way that you're building portfolios?
Sure. It's useful to ground the conversation today in how we think about before getting into what happened during the quarter. At the core, we believe that today's capital allocation decisions drive tomorrow's returns. It sounds straightforward, but it has real implications for how we construct our portfolios. We're not trying to predict short-term earnings beats or macro turning points. We're trying to identify companies that are making focused, differentiated investment decisions at precisely the moment when the return on that capital is set to improve. The capital allocation framework is a tool we use to make that judgment systematically. It evaluates not just how much capital a company is deploying, but where it's going, whether the industry setup supports a return on that investment, and how long that reinvestment runway extends. Each business is evaluated across multiple dimensions, and this gives us a consistent lens across very different industries and geographies, which is essential in a portfolio that spans emerging markets as broadly as ours do.
Great. So first quarter performance, good start for the year for sure. Your strategy return just underneath 7% against the benchmark that was essentially flat. Keep you walk us through some of what drove that result?
It was a strong quarter, and what made it particularly satisfying was that our outperformance came from multiple sources simultaneously rather than one concentrated bet. Starting with stock selection, which was the largest contributor. This reflects the underlying quality of the companies we own and the discipline with which we've constructed the portfolio. These are businesses where the capital allocation thesis is clear, reinvestment is focused, and the returns are improving. And that showed up in the fundamentals during the quarter. Industry positioning was also a large driver of outperformance. Our overweights in energy, cap goods, and financial services all work well, reflecting areas where we see disciplined capital deployment, improving industry structures, and rising return potential. Equally important was where we were not positioned. The underweights in tech, hardware, and equipment, banks, and pharmaceuticals and life sciences all supported our outperformance during the period. Perhaps also most notably, the avoided industries added quite materially to the quarter. That is a meaningful number and speaks directly to the discipline of avoidance as an active investment decision. There are parts of the market where capital is being deployed into overcapacity or structurally low return projects, and the framework is designed to keep us away from those areas. This quarter, that discipline was rewarded clearly.
And then thinking through the broader market forces that we saw over the first quarter, how did that macro environment cut both ways for the portfolio?
The first quarter was a turbulent one for global markets and EMs in particular. We navigated a complex and rapidly shifting backdrop. The dominant macro development was the escalation of the conflict in the Middle East following military engagement involving Iran. That event reverberated across energy markets, currencies, and investor risk appetite. Oil prices moved up sharply in the early weeks of the quarter, creating a meaningful tailwind for our energy exposed positions, which we had already been building on a bottom up basis. What was interesting is that the market's initial reaction was to sell off several Middle East exposed names indiscriminately, not because the underlying businesses were impaired, but because of geographic proximity to the conflict. We viewed that as an opportunity created by top down fear rather than bottom up reality, and we added selectively to names where the capital allocation thesis remained intact and the sell off had created a more attractive entry point. At the same time, U.S. trade policy uncertainty continued to weigh on global sentiment, with renewed tariff discussions creating volatility, particularly in technology, hardware, and export oriented manufacturing. The U.S. dollar remained a headwind for parts of emerging markets, though the divergence across currencies was significant. Several LATAM and Middle Eastern currencies held up well, which benefited our overall positioning. China's equity markets had continued volatility as investors weighed the durability of AI driven enthusiasm against ongoing property sector headwinds. Our exposure to China became more selective this quarter, concentrated in businesses like Alibaba, where we see a genuine capital reallocation story away from sprawling investments toward high return, scalable platform assets.
Great. And then let's start digging into some companies, some sectors. What contributed most to performance, and then any particular challenges that you saw.
Sure. On the positive side, the overweights in energy, cap goods, and financial services were the primary sector level contributors. Within energy, both Technip FMC and YPF performed strongly. Technip has been a beneficiary of continued offshore project sanctioning. The business is operating in an environment where the industry has systematically underinvested in conventional supply for several years. That is now translating into strong order books and improving economics. YPF continues to benefit from the combination of higher oil prices and execution in its Vaca Muerta investments. In financial services, B3 was the standout and our top contributor for the quarter as capital markets activity in Brazil accelerated, driven by improving macro sentiment and increased retail participation. B3's operating leverage came through clearly. On the detractor side, Samsung Biologic was our most meaningful drag. We believe the contract manufacturing thesis remains intact. The company is building capacity ahead of what we believe will be sustained demand from large pharma clients, but the near-term utilization commentary during the quarter was softer than expected, and growth expectations for 2026 were moderated slightly. We remain comfortable with the long-term capital allocation story. 361 WAM in India also lagged as more subdued domestic market activity weighed on revenue and fee income. This is a business we understand well and continue to monitor, but the near-term environment in India is a little bit more challenging.
And then let's talk a little bit more about B3. That was a top contributor. What would you say that illustrates about how the capital allocation decisions end up playing out?
B3 is a great example of a business that doesn't require a large amount of capital to grow, but it still has a very clear and deliberate investment agenda. Brazil's exchange operator sits at the center of an increasingly sophisticated ecosystem covering equities, derivatives, and fixed income clearing, post trade infrastructure, and the reinvestment has been focused on extending that platform's reach and monetization capacity rather than replicating it in other markets or chasing unrelated adjacencies. What the capital allocation framework rewards here is the combination of a structurally defensible position, disciplined reinvestment into capabilities that deepen their moat, and operating leverage that converts incremental volume into margin through operating leverage. Brazil's capital markets activity picked up during the quarter as a result of rising retail investor participation and the stabilizing interest rate environment. And those platform investments that B3 has made translated quickly into improved earnings. The incremental cost to process additional transactions through their infrastructure is very low, meaning that the incremental drop through to earnings and margins remain very attractive. This is a pattern we see across several of our highest conviction holdings in the portfolio, where the returns don't require consistently large capital infusions, but the right investment decisions made consistently over time with discipline around what not to pursue.
And then talk about some of the portfolio changes. Let's start with the exits. You made quite a few. Talk to me through some of these. What we're selling, why we're selling them.
Sure, we exited several positions during the quarter. The decisions fell into a few distinct categories. The first, most straightforward exits were in semiconductor and broader technology companies, where our investment thesis had largely played out. These were businesses where capital allocation had been excellent, the market had recognized that, and valuations had reached levels where the forward return potential was less compelling relative to what we could own instead. In those cases, taking profits was our disciplined decision, and the framework told us that the incremental capital was better deployed elsewhere. We also exited one oil services company that reached our target price. After the appreciation we saw over the last few quarters, accelerating further as energy markets moved higher this quarter, our assessment was that the near-term upside was well reflected in the stock price. These exits free capital that we were able to redeploy into the new positions added during the quarter, where we see a more attractive combination of capital allocation quality and forward return potential for the portfolio.
And then about 10, I believe 10 new positions are added this quarter. Different industries, different regions. Any common characteristics that you identified that were interesting when you picked up these opportunities?
Yeah, if you look on the surface, the additions are quite diverse. We have a Mexican bank, a Saudi financial institution, a UAE property developer, a Greek bank, a Turkish airport operator, a Chinese battery manufacturer, and an Indian port operator. Underneath the geographic and sector diversity, the common thread is consistent with what the framework always looks for: focused capital redeployment into improving return environments and economic uh, cycles, often at a point where the market hasn't fully priced that into the improving trajectory of the business. Several of the additions reflect our deliberate decision to increase exposure to the Middle East linked businesses. The conflict driven sell off in names with regional exposure gave us an attractive entry into Saudi National Bank, SABIC, and Emar Properties, each of which has a well established capital allocation thesis that we had been following for some time, where previously pricing had not been very compelling. And the sell off during the quarter changed that. TAV Airports was a similar dynamic, a business we know well through our existing research, operating infrastructure that is structurally insulated from short term regional volatility, where the market overreaction created an entry point aligned with our long term view on their concessions and capacity investment cycle. Alibaba represents a slightly different kind of opportunity. This is a capital reallocation story, a company that has spent years investing broadly across many business lines and is now being much more focused in its resources on the highest return opportunities, particularly around cloud infrastructure and AI capabilities. That shift in capital discipline is exactly what the framework is built to identify, and we took advantage with the opportunity at Alibaba.
All right, so sounds like you touched on a couple of Middle Eastern exposed names during that. During like we're looking at during the conflict and driven sell-off. Can we talk a little bit more about these names, what you thought through those, and how you made that decision in real time?
Sure. For examples like Saudi National Bank, SABIC, Emar, and TAV, we had already done the fundamental work. We understood the reinvestment priorities, the return trajectories, and the industry setups. The conflict introduced uncertainty, but in our view, it didn't change the structural logic of why these companies were investing where they were investing. The framework helped us distinguish between businesses where regional exposure was a genuine fundamental risk because revenues or costs were directly disrupted, and those where the market was simply applying an indiscriminate discount based on geography. In most cases, the businesses we added had limited direct operational exposure to the conflict areas, and the sell off was driven by investor risk aversion rather than impaired fundamentals. That distinction we think is important. We are not geopolitical forecasters. We don't build positions based on a macro view of how the conflict resolves necessarily. But when we see market dislocations that create entry points into businesses with strong capital allocation discipline and improving return profiles, the framework gives us the conviction to act, particularly with our long term investment time horizon. That's what happened here, and the positions we added to during the quarter largely reflect that.
All right, so thinking through, the five highest conviction holdings that you have: semis, semiconductors, the ports, some exchanges, petrochemicals, banking. Four different countries are hit. So you're really scattered all around. What gives you conviction across such a diverse set?
The conviction comes from the same source in each case: a clear view on where capital is being deployed, why the return on that capital is improving, and what the structural advantage makes those returns durable. Our largest position, TSMC, sits at the top because there is no more compelling capital allocation story within our markets right now. The company is investing at the leading edge of semiconductor manufacturing at a time when the performance gap between TSMC and every alternative is widening. Competitors face yield challenges, technology delays, and capital constraints that we think are structural rather than temporary. TSMC's investments into advanced packaging, 2 nanometer technology and beyond, and geographic expansion away from their home base in Taiwan are all building a platform that earns pricing power the market we think is not yet fully reflected. ICT, one of our other larger positions, is a different kind of compounding story. The company has an exceptional track record of brownfield expansion, adding capacity at existing ports with high incremental returns rather than building new infrastructure from scratch. Its long duration concessions, growing trade volumes in emerging markets, and a management team that has demonstrated capital discipline over decades gives us strong confidence in the reinvestment runway.
So looking ahead, where do you see the most compelling opportunities today, and what are some of the risks that could disrupt that picture?
Sure, we think the opportunity set in emerging markets continues to evolve. Our framework is seeing increasing divergence between companies that are investing with discipline and that those are constrained by legacy structures, policy uncertainty, or poorly timed capacity additions. The Middle East, we think, remains one of the more interesting areas. Vision 2030 in Saudi Arabia is generating a multi-year investment cycle that is still in its early stages, and many of the businesses benefiting from that cycle are deploying capital at high incremental returns. In technology, we are becoming a little bit more selective. The semiconductor investment cycle, which has been a significant driver of portfolio returns over the last few years, is showing early signs of moderation. Capacity additions are beginning to catch up with AI-driven demand in certain segments, and incremental returns on new capital are compressing from elevated levels. We are not broadly negative in technology, but we are focused on businesses where capital is shifting towards applied AI adoption, such as in software infrastructure and services, rather than those still in the heavy spend phase of the hardware cycle. Latin America remains a source of differentiated opportunity, particularly in Brazil and Mexico. We've talked about B3, but Banorte, YPF, each reflect distinct capital allocation stories that are at attractive stages of their reinvestment cycles. The key risks we are monitoring as a team are trade policy escalation, which creates unpredictable costs and demand disruptions across our more globally integrated holdings or those that rely on trade, currency volatility in some of the higher beta EM economies, and any renewed acceleration of China's export overcapacity in industries where our companies compete. We are also watching geopolitical developments closely, not necessarily to predict outcomes, but to ensure that the businesses we own can withstand a range of scenarios without impairing their long-term capital allocation capacities.
Great. All right, Kevin. Well, that was a great recap of the quarter and to see what's ahead. And with that, let's take a look at returns. In the first quarter of 2026, the Vaughan Nelson Emerging Market Strategy returned 6.86% gross, 6.57% net against the MSCI Emerging Markets Index at negative 0.17%. Over the course of the past 1 year, the Vaughan Nelson Emerging Market Strategy has returned 52.67% gross, 51.05% net, and the MSCI Emerging Markets Index is at 29.55%. And lastly, since inception, the Vaughan Nelson Emerging Market Strategy has returned 24.98% gross, 23.63% net, and the MSCI Emerging Markets Index is at 18.34%. With that, that's a wrap on the first quarter, Kevin. So thank you so much, and we'll have you back in here soon.
Thanks so much, Dan. We'll see you next quarter.
The views, information, and/or opinions expressed during this podcast are solely those of the individuals involved and do not necessarily represent those of Vaughan Nelson and its employees. Vaughan Nelson does not verify and assumes no responsibility for the accuracy of any of the information contained in the podcast. The primary purpose of the information, opinions, and thoughts presented in this podcast is to educate and inform. This podcast, or any podcast in the series, does not constitute professional investment advice or services, and any reliance on the information provided is done at your own risk. Past performance is not an indication of future performance. By accessing this podcast, you acknowledge that the entire contents of this podcast are the property of Vaughan Nelson or used by Vaughan Nelson with permission and are protected under U.S. copyright and trademark laws. Securities discussed within this podcast may be held in the Vaughan Nelson strategies.